If you walk into a state-of-the-art AI data center today, the biggest threat to the billion-dollar algorithms isn't some, sophisticated cyber attack.
No, it's actually just heat,
Right. It is the absolute unforgiving laws of thermodynamics.
which is wild to think about.
It really is. So today, we are jumping into a deep dive on the financial documents of the company whose specialty chemicals literally stop the internet from melting down.
Element Solutions, Inc.
Exactly, ESI. Okay, let's unpack this because we have their Q1 2026 earnings presentation and press release. And I mean, the top line numbers here are just jarring.
Yeah, they really jump off the page.
They reported net sales hitting $840 million, which is a massive 41% increase year over year.
It is.
I mean, if you just read the headline, you'd think this established specialty chemicals company suddenly found a license to print money.
Well, that 41% figure certainly demands attention, but, as with all financial documents, the headline is a very blunt instrument.
Fair enough.
We have to parse that out immediately. The 41% is their reported growth, but their underlying organic growth, meaning the growth of the actual business they already owned before this year, that was only 10%.
Wait, hold on. There is a 31% difference between the headline growth and what their core business actually did.
There is. And that massive gap is what makes this quarter so complex to analyze.
So what's our mission here?
Our mission today is to separate that 10% organic demand from a massive shopping spree the company recently went on. And crucially, we have to look at how extreme volatility in global metal markets is actively masking their true profitability. We need to strip away all the accounting noise to see the physical engine underneath.
I actually want to start with that physical engine because to understand that 10% organic growth, we have to kind of stop thinking about technology as some weightless, abstract cloud.
Right, it's very physical.
Extremely. Let's look at their electronics segment, which saw organic sales grow an impressive 15%. Reading the commentary from their CEO, Benjamin Glicklich, he highlights that the supply chain is basically scrambling to support the infrastructure required for AI.
Yeah, the build-out is massive.
And he uses terms like thermal management, power density, and advanced packaging. I mean, I get that thermal management is just dealing with heat, but what does power density actually mean in a server rack?
So power density refers to how much electrical power is being consumed and therefore how much heat is being generated in a specific physical area.
Okay.
Historically, chips were laid out flat on a motherboard, just side by side. But to achieve the processing speeds required for AI, engineers are now using what they call advanced packaging.
Which means what, exactly?
They're stacking chips vertically, like 3D style. They're cramming billions more transistors into the exact same footprint.
Oh, wow. So you have multiple, microscopic hot plates stacked directly on top of each other, all running at maximum capacity.
Exactly. And that creates a terrifying physical problem.
Because of the heat.
Right. If the heat generated by that dense stack cannot escape instantly, the silicon physically degrades. It literally destroys itself.
You can't just put a bigger fan on it.
No, absolutely not.
Yeah.
You need highly engineered thermal interface materials because at a microscopic level, the surfaces of these chips and their heat sinks are not perfectly flat.
They have ridges and stuff.
Yeah, tiny ridges. And if air gets trapped in those ridges, air acts as an insulator and the chip burns up.
I'm trying to picture the scale of this. It sounds a bit like we are trying to take the engine of a supersonic fighter jet and cram it under the hood of a standard four-door sedan.
That is a great way to think about it.
Right, because the sheer violence of that power density would just vibrate the chassis to pieces or melt the frame within seconds.
That analogy holds up perfectly. In this scenario, the artificial intelligence chips designed by the mega-cap tech giants, those are the jet engine.
And ESI is what?
ESI is engineering the coolant. They manufacture specialized thermal pastes and advanced circuitry materials that fill those microscopic gaps and pull the heat away.
Wow.
If ESI's materials fail, the billion-dollar data center disintegrates.
It is the ultimate picks and shovels play. They aren't trying to build the next great language model. They're providing the physical materials that make the infrastructure survive the experience.
Precisely.
And looking at the documents, they mention they're expanding capacity for something called Cuprion. What is that?
Cuprion is really interesting. It's a highly specialized sintered copper paste.
Okay.
See, traditional solders used to connect components can actually melt or fail under the extreme temperatures of AI workloads.
Because it gets so hot.
Right. Copper conducts heat significantly better, but it's really hard to work with at microscopic levels. This Cuprion paste allows manufacturers to create pure copper connections that can actually withstand the punishing environment of a high-density AI server.
So that perfectly explains the 15% organic surge in the electronics division.
Yeah, it's a huge driver.
But reading further into the documents, this isn't exclusively about AI data centers, is it?
No, not entirely.
Because they note a recovery in the Western electric vehicle market, which obviously requires advanced plating products for all their internal electronics. And they also mention ongoing demand for high-layer count, server boards, and Korean smartphones.
Those high-layer count boards are fascinating in themselves.
Right.
We aren't talking about your standard, simple green circuit board anymore.
Right.
These are printed circuit boards with 20, 30, or even 40 distinct layers of circuitry sandwiched together to route power and data.
40 layers.
Yeah, and creating those layers requires hyper-specific plating chemistry, which is ESI's bread and butter.
Okay, so the core business is highly technical and growing organically at a very healthy 10%.
Yes.
But I want to go back to what we said at the start. If the organic growth was 10%, how did overall sales jump 41%? You mentioned a shopping spree earlier.
Yeah, they basically brought out the checkbook. If organic growth measures the performance of your existing business, inorganic growth comes from buying new ones. In the first quarter of 2026, Element Solutions executed a massive capital deployment strategy.
Right. Let's look at the two major acquisitions from your source material. First, on January 2nd, they bought EFC Gases and Advanced Materials for about $367 million.
Correct.
Then, exactly 1 month later, they bought Micromax for roughly $493 million.
So between those two, they spent over $860 million in a single quarter.
Which is wild. It is an incredibly aggressive move. They effectively bought the rest of that top-line headline growth.
They did.
But I have to push back on this strategy.
All right, go ahead.
Because when I see a company dropping almost $1 billion to buy revenue, right as the AI market is dominating headlines, it makes me pretty skeptical.
Understandably so.
Are they just inflating their top-line sales numbers to look like a bigger player? It feels a bit like, buying a bigger scoreboard instead of actually playing a better game.
That's a fair concern.
Because normally when you buy that much revenue, your overall profit margins take a huge hit. You end up absorbing all the inefficiencies of the new companies you just bought.
Your skepticism is entirely warranted. Buying vanity revenue is a classic pitfall in corporate finance.
Right.
But to see if that happened here, we have to look past the top-line net sales and examine the profit contributions of these specific acquisitions.
And what do the numbers say?
The numbers suggest these were highly accretive to the bottom line immediately. Let's look at a metric called adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization.
So basically a measure of the core operating profitability of the business before the accountants get involved and muddy the waters.
Exactly. In the electronics segment, that Micromax acquisition alone contributed 11% to their constant currency adjusted EBITDA growth.
11%. And just to clarify for everyone listening, constant currency means they calculate that without letting international exchange rates mess up the math.
Right. And then over in the specialty segment, the EFC Gases acquisition added 9% to their adjusted EBITDA growth.
So it wasn't empty revenue at all.
Yeah.
They bought actual immediate profit generation.
Yes.
But what exactly do these two companies do that makes them so profitable right off the bat?
They provide specific technical capabilities that ESI's existing customers desperately need right now. Let's take Micromax. They supply advanced electronics, inks, and pastes.
Okay, like for circuit boards.
Yes, but these aren't inks for a printer on your desk. These are inks that actually conduct electricity. They are printed onto substrates to create flexible, highly durable, heat-resistant circuits.
Which goes right back to the thermal management problem we talked about earlier.
Precisely. And then there's EFC Gases, which provides high-purity specialty gases.
What do you need gas for in a microchip?
Well, when semiconductor manufacturers are doing that advanced 3D packaging we discussed, they use lasers and chemical vapor to etch microscopic pathways into the silicon. To do that without contaminating the chip, you need ultra-pure gases, things like specialized neon, krypton, or xenon mixtures.
Okay.
By acquiring EFC, Element Solutions can now offer those crucial gases to the exact same data center clients who are already buying their thermal pastes.
Ah, so they are expanding the menu for a captive audience. That makes a lot of strategic sense.
It really does.
But, as long as we are digging into the core profitability, I have to point something out. I'm looking at their net income line, and it looks like an absolute disaster.
Yeah, it does look bad at first glance.
Net income dropped 43%, down to $56 million. But you just told me their adjusted EBITDA increased 26% to $162 million.
I did.
I am genuinely confused here. How can a company's profit drop by 43% and rise by 26% in the exact same quarter? What am I missing?
You are looking at the profit paradox of the quarter, and it highlights perfectly why you can never just read the first page of an earnings report. Let's tackle that 43% drop in net income first. It is almost entirely a mirage created by the calendar.
A mirage.
Yes. During the same quarter of the prior year, ESI divested, meaning they sold off a legacy business called McDermott Graphics Solutions.
Okay.
When you sell an entire business, you record a massive one-time pile of cash on your income statement.
Oh, I see. So last year's net income was artificially inflated by a one-time windfall from selling off a division.
Exactly.
Comparing this year's normal operations to last year's massive windfall makes it look like the business is collapsing.
When in reality, it's just returning to its baseline without that temporary boost.
Okay, that totally clears up the drop. But what about the surge in the adjusted EBITDA? Because the documents point to something called pass-through metals, and the raw numbers here are wild.
They are.
ESI saw a 152% spike in the value of these metals. Last year, they accounted for about $101 million. This quarter, it was almost $256 million.
Yeah.
What exactly is a pass-through metal?
This is where global commodity markets collide with specialty manufacturing. Creating these advanced pastes and plating chemicals requires large amounts of precious and specialty metals, things like palladium, copper, and silver.
Right.
Due to a variety of global macroeconomic factors, the prices for those raw metals absolutely skyrocketed this quarter. ESI's cost went way up.
Ouch.
But because of the way their contracts are structured, they do not eat that cost. They pass it directly through to their customers.
Wait, if they just pass the exact cost of the metal to the customer, why does that matter? It shouldn't impact their profit at all, right?
In terms of raw dollars, it doesn't. You're right.
Yeah.
But in terms of profit margins, it completely distorts the math.
How so?
Think about the equation for a profit margin. It is your profit divided by your total revenue. Let's say you sell a product for $100 and you make $10 in profit. You have a 10% profit margin.
Yeah, simple enough.
Now, let's say the global price of the raw metal inside that product doubles. You pass that cost along, so now you have to charge the customer $200.
Right.
You are still only making that exact same $10 of profit for your labor and engineering. But now your margin is $10 divided by $200. Your profit margin just dropped to 5%.
Oh, wow. So it's like being a custom jeweler.
Okay, yeah.
If the global price of gold doubles overnight, you have to charge twice as much for a bespoke ring just to cover your materials.
Exactly.
Your top-line revenue doubles, which looks amazing on paper, but your actual skill, your craftsmanship, the true profit you make per ring, that didn't change at all.
Not one bit.
The inflated cost of the gold just makes your profit margin look terrible because the denominator of the equation got artificially huge.
That analogy captures the exact mathematical problem ESI faced this quarter. The massive spike in the value of pass-through metals made the company look bigger in terms of revenue, but mathematically less efficient in terms of margin.
That is so frustrating for them.
It is. So management made a significant change to how they report their numbers. They completely excluded the value of those pass-through metals from their adjusted EBITDA margin calculation.
And took it out.
Yep. They stripped the gold out of the jeweler's math to just look at the value of the craftsmanship.
And what happened to the numbers when they did that?
The underlying truth of their operations was revealed. Their core adjusted EBITDA margin actually improved by 170 basis points, rising to 27.8%.
Wow. So 170 basis points, meaning an improvement of 1.7%, might not sound like a lot to a casual observer. But when we are talking about hundreds of millions of dollars, that is a massive reveal.
Huge.
By stripping out the commodity inflation, it proves their core business. The actual engineering of the coolants and pastes is becoming significantly more profitable.
It proves they possess strong operational leverage. As their sales volumes increase to meet this AI demand, They are managing their internal costs so effectively that a larger percentage of every dollar earned drops straight to the bottom line.
Okay, I am with you on the math. The core business is highly profitable.
Yes.
But, and this brings me to another contradiction in these documents, if margins are up and core profits are up, why did ESI report a negative free cash flow of $74 million for the quarter?
It does seem counterintuitive.
A highly profitable company bleeding $74 million in cash over 3 months seems deeply alarming.
Well, it would be alarming if they were losing that money to operational failures.
Yeah.
But to understand that negative free cash flow, you have to look at the balance sheet, specifically a line item called working capital.
Okay.
ESI took over $160 million in cash and intentionally tied it up in working capital.
And working capital in this context is mostly inventory, right? Like they're buying raw materials.
Yes, exactly. They are intentionally burning cash right now to aggressively stockpile raw materials all around the globe
Why?
because of the macro environment. In his commentary, the CEO explicitly calls out complex geopolitical risks. He points to the ongoing war in Ukraine, hostilities in the Middle East affecting shipping lanes, the threat of new trade tariffs, and persistent inflation.
Right.
We are living in a world of incredibly fragile supply chains.
We all remember the supply chain nightmare from a few years ago. I mean, you could have $1 billion of customer demand, but if you can't source the palladium or the specialty gases to build the product, your revenue goes to zero.
Exactly. And ESI's customers are currently giving them massive increases in order forecasts. The data center builders are saying, look, we are going to need a lot more of your product very soon.
They are bracing for impact.
So ESI is making a strategic choice. They are willing to take a hit on their short-term cash flow to hoard inventory and secure their supply lines now.
That makes sense.
They are guaranteeing to their major tech clients that no matter what happens geopolitically, ESI will not be the bottleneck that delays a state-of-the-art AI facility.
They are paying a premium to be the most reliable player on the board.
Exactly.
And looking at their capital expenditures, or CapEx, they aren't just buying raw materials either. They spent $25 million this quarter as part of a $75 to $100 million full-year plan to physically expand their capacity for high-value products.
That ties directly back to Cuprion, the sintered copper paste we discussed earlier.
Oh, right.
They are literally building the factories required to manufacture the specialized thermal materials that the next generation of AI chips will absolutely demand.
Which brings us to, honestly, the ultimate signal of how confident management is in this strategy.
Right.
Normally, if a company reports negative $74 million in free cash flow, Wall Street analysts might panic. But ESI actually raised their full-year guidance.
They did.
They now project full-year adjusted EBITDA to land between $665 million and $685 million.
You do not raise your full-year earnings guidance if you are genuinely worried about your cash position.
To add to that, they also plan to reduce their leverage ratio, which is currently at 3.1 times by half a turn by the end of the year, assuming they don't make any more big acquisitions.
So down to about 2.6.
Exactly. Basically, paying down their debt relative to their earnings. They are looking at the market and saying, yes, we burned cash this quarter to build a fortress of inventory and buy 2 new companies. But the AI demand is so locked in that we will make all that cash back, hit record profits, and pay down debt by December.
It is a remarkable narrative of corporate agility. They used the first quarter to aggressively position themselves for the rest of the decade.
Yeah, they really did.
They absorbed the shock of skyrocketing metal prices and used pass-through contracts to protect their margins. They locked down their physical supply chains by hoarding inventory. They essentially built a geopolitical shock absorber around their entire business model.
Which really reframes how you look at the entire technology sector. The next time you open a news app and read a breathless headline about a massive new AI data center being built or a revolutionary leap in high-performance computing, you will have a completely different perspective.
Definitely.
You will know that the true unsung heroes making that leap possible aren't just the software engineers writing code. The heroes are the specialty chemical companies engineering the highly specific, incredibly resilient physical materials that keep that digital world from literally melting into a puddle of slag.
It forces a necessary respect for the physical constraints of our digital ambitions. I mean, software might feel infinite, but the hardware required to run it is strictly bound by the laws of chemistry and thermodynamics.
Which leaves us with a final, somewhat provocative thought for you to ponder. We've spent this time exploring how global tech dominance right now is entirely dependent on hyperspecific conductive inks, high-purity gases, and rare metal like palladium and copper.
Right.
We know the algorithms will keep getting smarter, and the software will keep demanding more power density. But does the true choke point of future innovation lie not in the code itself, but in the physical availability of these raw materials?
It's a great question.
What happens to the limitless potential of artificial intelligence when those finite physical resources finally hit a hard limit? Because as we've learned today, you can design the most advanced engine in the world, but if you don't have the chemistry to keep it cool, you aren't going anywhere.